Your money-making broadcast starts now. Good evening. Wednesday, May 27, 2026. I am your host for Global Econ Pulse, and this is your complete market briefing for what is shaping up to be the most consequential macro week of the month. Wall Street closed with a mixed and subdued tape today as traders positioned ahead of Salesforce earnings after the bell and the heaviest data calendar in weeks. The S&P 500 held steady at 7,520, up 2 basis points. The Nasdaq Composite edged up 0.07 to 26,674. The Dow Jones Industrial Average added 36 basis points to close at 50,644. The CBOE Volatility Index dropped more than 4% to 16.29, a level that suggests options markets are not pricing in significant dislocation despite the stacked calendar. The Russell 2000, tracked by the IWM Fund, surged more than 5% in Tuesday's session, confirming a broadening rotation into small-cap names that signals institutional appetite beyond the familiar mega-cap names. But beneath the surface calm, the portfolio holds 74.5% in cash, deliberately defensive ahead of 3 binary catalysts in 4 days: CRM earnings tonight, the second estimate of GDP on Thursday, and the April PCE price index on Friday. This is the tension that defines the current moment. The tape says calm, the calendar says prepare. Let us start with the headline event of the evening. Salesforce reports earnings after the close tonight, and the setup is more interesting than the headline numbers suggest. CRM shares eased 0.88% to $177.51, with the decline reflecting expectations that have been steadily lowered heading into the print. Citi maintains a $225 price target, representing roughly 27% upside from current levels. The fact that the consensus bar has been lowered creates a classic asymmetry. The company does not need to deliver a blowout quarter to surprise positively, it simply needs to clear a reduced hurdle. This is the contrarian framework articulated by John Templeton, the legendary global investor who founded the Templeton Growth Fund and pioneered the concept of buying maximum pessimism. Templeton argued that the best opportunities emerge when expectations are at their nadir, because that is when the gap between perception and reality is widest. CRM entering this print with lowered expectations, a reasonable $165 stop-loss level, and a Citi price target indicating material upside fits squarely within the Templeton playbook. The question is not whether CRM crushes estimates in absolute terms, the question is whether the market has already priced in so much negativity that any reasonable result becomes a positive catalyst. That asymmetry is what contrarian investing is built on. And then there is the oil story, which dominated commodity markets today and rippled into equities in a way that demands attention. Crude oil plunged 4.36%, its largest single-day decline in weeks, driven by rumors of a potential Iran peace deal circulating through Washington and Gulf diplomatic channels. The direct equity beneficiary was Carnival Corporation, which surged 4.75% to $27.98. The logic is straightforward: fuel represents a significant operating cost for cruise operators, and each dollar decline in crude directly expands margin structure. CCL was the standout performer in the leisure space today, and the volume confirmed institutional accumulation rather than retail noise. Paul Tudor Jones, the legendary macro trader who famously predicted the 1987 market crash and founded the Robin Hood Foundation, built his career on a single unwavering principle: price action is the ultimate authority. Narrative follows price, not the other way around. When a stock rallies 4.75% on a macro catalyst like lower oil, the price is telling you that sophisticated capital sees a durable tailwind. Traders may debate the Iran peace timeline, and skepticism about a quick resolution is warranted given the history of failed negotiations. But Paul Tudor Jones would instruct us to respect what the tape is showing. The price action in CCL is speaking clearly, and ignoring it in favor of narrative skepticism is precisely the mistake that macro traders are trained to avoid. The broadening of the bull market beyond megacap technology is perhaps the most constructive development of this cycle. We are approaching the 35th day of this rally leg, and the Russell 2000 surging more than 5% in Tuesday's session represents the strongest confirmation yet that the bull market is expanding its base of support. For weeks, critics argued that the rally was dangerously narrow, concentrated in a handful of AI megacap names that were pulling the indices higher while the median stock languished. Tuesday's action directly refutes that narrative. Small caps are participating. Value is rotating. The tape is telling us that investors are finding opportunity across the market cap spectrum, not just in the familiar names. But the second-level thinker pauses here and asks a different question. Howard Marks, the co-founder of Oaktree Capital Management and the most articulate advocate of second-level thinking on Wall Street, warns us that the consensus is always priced in. When the VIX sits at 16.29, the market is telling us it expects a calm week. But the calendar includes CRM earnings tonight, the second GDP estimate on Thursday, and PCE on Friday. 3 binary catalysts. 1 VIX reading of 16.29. Second-level thinking requires us to ask what could go wrong that the market is not pricing. The consensus expects the data to be benign. What if it is not? What if PCE comes in hot and forces a repricing of rate expectations? What if CRM guidance underwhelms? Howard Marks would say that the time to worry is when no one else is worrying, and right now, the VIX is telling us that no one is worrying. That is precisely the environment where second-level thinking adds the most value. In the technology and innovation complex, two names are telling a powerful secular story. Micron Technology surged 3.63% to $928, continuing its march toward landmark territory. At current levels, MU is approaching $1 trillion market capitalization, a milestone that would cement the semiconductor cycle as one of the most durable in market history. Rocket Lab gained 4.91% to $150 as the space economy continues its acceleration, with RKLB establishing itself as the purest publicly traded vehicle for the commercial space infrastructure build-out. Cathie Wood, the CEO and founder of ARK Invest, who has become the face of innovation investing on Wall Street, frames technology adoption through the lens of the innovation S-curve. The thesis is that disruptive technologies follow a predictable pattern: slow early adoption, followed by an inflection point, followed by exponential growth, followed by maturation. Both MU and RKLB are in the exponential phase of their respective S-curves. The semiconductor cycle is not a one-quarter phenomenon driven by a single product cycle. It is a multi-year structural shift as AI inference moves from the training phase into widespread deployment, requiring exponentially more memory and compute capacity. Cathie Wood's framework would tell us that we are still in the middle innings of this adoption curve, not the ninth inning. The AMD pullback of 1.66% today to $495.54, coming after a 7.78% surge, is a natural consolidation within a secular uptrend, not a signal of structural weakness. AMD continues to compete for AI GPU market share, and the product roadmap remains competitive. In the context of the S-curve, a single-day pullback is noise. The defensive posture of the portfolio reflects a philosophy that predates any single market cycle. The cash allocation stands at 74.5%, a deliberate and strategic position heading into this dense calendar week. Stanley Druckenmiller, the legendary hedge fund manager who never recorded a single losing year in his 3 decades running Duquesne Capital, built his entire approach around one non-negotiable principle: the first rule of investing is never to lose money. Capital preservation is not a passive strategy, it is the active choice to maintain optionality. Druckenmiller has said that his edge came not from being right more often than other traders, but from knowing how much to bet when he was right and how little to bet when he was uncertain. This week, with 3 binary events stacked into a 4-day window, uncertainty is elevated. CRM earnings are a single stock catalyst but carry index-level weight given the weighting of technology in the benchmarks. GDP on Thursday is the second estimate, but any material revision from the advance print would move markets. PCE on Friday is the Fed's preferred inflation gauge and the single most important data point before the June FOMC meeting. In a week with this many variables, the appropriate response is not to place aggressive directional bets but to hold powder and wait for clarity. That is Druckenmiller's capital preservation framework in practice. Now let us turn to the recommended stock lineup for investors looking for specific ideas, all 4 of which are priced at $35 or below, making them accessible across portfolio sizes. First, the safe play, Pfizer at $26.21. PFE is a defensive pharmaceutical giant with a reliable dividend and a pipeline that spans oncology, vaccines, and rare diseases. In a volatile macro week when the data calendar is stacked with binary risks, Pfizer offers stability and income. The stock does not need to rally to be a successful position, it simply needs to hold its ground while the broader market processes uncertainty. That is the definition of a defensive anchor. Second, the balanced play, SoFi Technologies at $16.17. The relative strength index sits at 44, signaling oversold conditions after a recent pullback that has been driven by sentiment rather than fundamentals. With 486 shares held in the model portfolio, this is a conviction position that reflects a value opportunity in the fintech space. Howard Marks would remind us that the time to deploy capital is when pessimism is thickest, not when optimism is at its peak. The current sentiment toward fintech names reflects skepticism about the consumer and the competitive landscape. That skepticism is precisely what creates opportunity for disciplined investors who can look through the cycle. SoFi's user growth trajectory, its path to sustained profitability, and its expanding product suite are not fully reflected in the current price. Third, the high-growth play, Carnival Corporation at $27.98. The oil crash catalyst is real and material. A 4.75% gain on volume that confirmed institutional participation validates the thesis. Paul Tudor Jones's price priority framework is relevant here, The price action in CCL is telling investors that lower fuel costs meaningfully improve the earnings outlook for the cruise operator. Every dollar that oil declines flows directly to CCL's bottom line through improved operating margins. Fourth, the low price play, Ford Motor Company at $15.88. Ford offers a combination of dividend yield and uptrend momentum that is rare in the current market. Tuesday's 3.66% gain was accompanied by democratic price action, meaning broad-based buying that reflects genuine demand rather than algorithmic noise. The entry point is clean for income-oriented investors who want exposure to industrial cyclicals with a dividend cushion. Ford's restructuring progress and hybrid vehicle strategy provide additional optionality beyond the dividend. The broader macro context is worth emphasizing. This week features the most concentrated cluster of high-impact data since the April employment report. CRM earnings tonight will set the tone for the technology sector heading into June. The second estimate of GDP on Thursday will provide a more refined picture of first-quarter economic activity, with particular attention to the consumption component. The April PCE price index on Friday is the marquee event for fixed-income markets, as it represents the Fed's preferred inflation gauge and will influence the dot plot at the June meeting. The market is currently pricing a relatively benign path for inflation, but the PCE print carries the potential to disrupt that consensus. If core PCE comes in above expectations, the probability of a hawkish surprise at the June FOMC meeting increases materially. If it comes in below expectations, the opposite dynamic applies. In either case, holding 74.5% cash allows the flexibility to respond rather than react. To summarize the key takeaways from tonight's briefing, the market is approaching a critical inflection point with 3 binary catalysts in a 4-day window. CRM earnings tonight represent the first test, and the lowered expectations create the contrarian asymmetry that John Templeton would recognize. The oil crash has injected a new variable into the macro equation, and the price action in CCL is telling a clear story that Paul Tudor Jones would instruct us to follow. The broadening of the bull market into small caps is the most constructive technical development of this cycle, but Howard Marks would remind us that the calm in the VIX may be misleading. The 74.5% cash allocation reflects the capital preservation discipline of Stanley Druckenmiller, preserving optionality for the opportunities that this week will surely present. Stay disciplined, stay patient, and let the data guide the next allocation decision. This has been your Global Econ Pulse briefing for Wednesday, May 27th. Check our shorts for a 60-second highlight. That's all for today. We all become wealthy together.